Working a job and collecting a paycheck is necessary to survive, but relying on it alone to build wealth, the math is entirely against you. The primary headwind is the silent tax of inflation. While bank savings sit flat, 6% inflation erodes what that money can buy. Left untouched for 12 years, its purchasing power drops by 50%. Half your wealth is gone. The mathematical escape route is acquiring assets. Strictly defined, an asset is a vehicle or system that generates money or value completely independent of your daily labor. The problem today is the sheer volume of noise. Open your phone and you are bombarded with conflicting advice, pushing everything from obscure crypto tokens to wholesale real estate. Choosing an asset that doesn't align with your current life stage, your available time, or your actual capital will lead to prolonged stress or a complete wipeout of your savings. Building financial independence requires ignoring the lottery ticket mentality. You have to match the right asset class to the resources you actually hold right now. To cut through the noise, we are going to evaluate 7 specific pathways using a single framework, plotting the active effort required against the probable risk and output. Directly. First, individual stocks sit firmly in the high-effort, high-volatility quadrant. Buying single stocks demands upfront capital and deep ongoing research to identify undervalued companies. You are effectively handing your money over and placing extreme trust in a corporate management team to outperform the market. The upside is steep. Pick the right company and your initial investment can multiply several times over a 5-year span. But that potential carries a high emotional cost. If that single company makes a catastrophic error, your entire investment takes the direct hit. If you want to drop the active effort, you move to the bottom left quadrant, index funds and mutual funds. Rather than agonizing over individual balance sheets, index funds bypass the micro-level research. They simply track broad macroeconomic growth and the decades-long expansion of the middle class. You give up the chance of a sudden, isolated spike in returns. In exchange, you get low-friction, mathematical probability over a long timeline. If you are a time-poor professional with zero desire to analyze quarterly earnings reports, index funds are your mandatory foundational asset. Beyond generating returns, protecting existing wealth from government devaluation requires a specific allocation toward gold and crypto. When central banks print an unending supply of fiat money to manage economic crises, that excess supply directly inflates the prices of everyday goods. Digital gold acts as a physical counterweight. It is a stable, low-yield asset designed purely to preserve your baseline purchasing power rather than to make you wealthy. On the opposite end of the spectrum are major cryptocurrencies like Bitcoin and Ethereum, offering a significant asymmetrical upside alternative to traditional hedges. Historically, strategic allocations here have grown by thousands of % over a relatively short multi-year span. The trade-off here is intensely psychological. You must possess the fortitude to watch an investment drop near zero during a bear market without panic selling. To survive that volatility, you strictly limit your exposure. Keep speculative assets to 5 or 10% of your total portfolio, capping your potential losses. Gold protects your financial floor, while calculated risks in crypto can elevate your ceiling. The key is rigidly controlling your allocation to both. For generating reliable passive income, we look to commercial real estate. Note the distinction. This is entirely separate from tying up capital in a primary residence. The prohibitive barrier to entry is the capital requirement for commercial property, along with significant leverage and property management logistics. The payoff is dual-layered. You generate consistent, inflation-adjusted monthly rent, while the underlying property itself appreciates in value over time. However, real estate is highly illiquid. If you are in your 20s, sinking your early savings into residential real estate can severely restrict your geographic career mobility. If you lack the financial capital for physical property, you pivot to intellectual property and self-investment. These require $0 but demand years of consistent output. Your ability to generate value starts with your physical and mental capacity. Reading books, taking targeted courses, and maintaining your health are the baseline requirements for out-earning your peers. You then translate that capacity into digital intellectual property, whether that is writing a book, coding software, or creating a digital product. You build it once, and it scales with near-zero marginal cost. This path requires extreme delayed gratification. The hours you put in during your 20s will largely go unrewarded, only to compound into exponential returns in your 30s. When you have zero financial capital to deploy, your time and your intellectual focus are the only currencies you can spend to escape the salary trap. Wealth is built by owning systems that generate income while you focus on other things. To put this into practice, let's map these assets to two distinct investor archetypes. First is the time-rich beginner. You are likely in your 20s, low on capital but high on energy. Your priority is aggressive self-education and intellectual property creation. Avoid tying yourself down with illiquid real estate. Park whatever early savings you manage to gather into index funds and allocate a small, calculated 5 to 10% risk into crypto. The second archetype is the time-poor high earner. Your primary goal is defensive compounding of your active salary. Ignore individual stock picking entirely. Instead, deploy capital into index funds and commercial real estate for reliable passive cash flow. Finally, utilize digital gold as a low-effort, stable hedge to protect cash reserves from inflation. Stop searching for a perfect investment. Identify your current resources, accept your archetype's trade-offs, and step back so time can do the heavy lifting.